Hey everyone, welcome back to Yuri's Box. In today's video, I'm going to talk about a bit of everything. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So the first part of the video, I'm going to further elaborate, as I promised in the comments, on this comment. And the second part, I'm going to be talking about really April 9th and what we can expect. It's kind of been already spoiled since the latest headlines have already reached the markets, but we'll talk about everything. So first of all, I thank as usual everything that has been commenting, and if I had to take something from this comment, the main rebuttal is that things can't really be compared with in regard to the things that caused 2006 and 2008, which is absolutely absolutely fair rebuttal. Now, I personally say in my videos that every cycle is different, and there are things that make each cycle unique. But I will provide a further reason, a further piece of evidence for why the comparison, not just on the chart, but at really a fundamental level, is relevant. So DV Zinex 7941. I hope you enjoy the video, and I hope everyone else enjoys the video. So before I want to lay some groundwork. All right. So why can we really at least make the case that it is somewhat similar, what we're living today, to 2006, 2008. And again, I want to build on that. So we're going to look at basically the 2010s, okay? And one of the consensus ideas that I read most often is that we didn't have a recession in the 2010s because of all the money printing. And so, central banks avoided recessions by just having the Fed funds rate at zero and, doing QE and just flooding the markets with liquidity. That, however, goes against one of my closest held beliefs, which is that the Fed isn't a preemptive actor. The Fed is in the business of anticipating events. It is in the business of reacting to events. And in my previous videos, I made the case. That's actually one of the first videos I made when looking at the SEP. Now, if you look at March of 2024, we were still looking at a fair amount of rate cuts. All right, we were still at 5.5 on the Fed funds rate. The Fed had basically signaled that if inflation is well behaved, we can go ahead and cut. All right, that's what fueled a lot of the move that we saw in the S&P 500, really from the end of October up until the end of March. But after that, if you look at what actually happened, inflation didn't really cooperate, and sure enough, from then on, expected rate cuts got wiped off the map because inflation is a problem. So we can't cut anymore. And so surely you can see rate expectations for 2024 right here move up, as well as 2025. They slowly drift higher. You see the dots drifting higher. Again, and this will be the last example I make, after June, after inflation became a problem, this would be right here. Sure enough, what happened after that is disinflation, further disinflation, which culminated with the growth scare we had in the summertime in August, and with all the yen carry trade drama. Sure enough, in September's summary of economic projections, it's rate cuts galore. All right, just look at 2024. This is September. This is June. Just look at how the dots just drift lower. They catch the elevator and they go down. Same thing for 2025. Everyone's signaling cuts. All right, now, I don't want to waste any more time. Basically, you get the picture. The Fed isn't really in the business of anticipating things. Whatever is the latest headline, they'll react to it. All right? That is what they do. Now, why do I kind of point this out before moving forward? Because we're going to look at the quits rate, all right? And keep in mind, what the Fed does. The quits rate really, the way I think about the quits rate is a survey of people's emotions without all of the noise associated with surveys. So, for instance, I always make the example of the University of Michigan, all right? The consumer surveys that come out. They can easily be skewed by political leanings, all right? If you're a Democrat, Trump gets elected, you think the world's going to end. And if you're a Republican and Biden gets elected, you think the world is going to end, all right? The quits rate has none of it. It's just signal. Because if you have the quits rate at cycle highs, that can tell you that generally speaking, labor market participants see abundance in the economy. And whenever the quits rate is at cycle lows, people really no longer see the abundance that they saw back at cycle when the quits rate was at cycle highs. So people are pulling back. They're no longer acting in an aggressive manner, and so they're staying put. All right, and they're telling you that the economy isn't as good as it used to be. Now, looking back, we don't have a lot of history on the quits rate. It only goes back to really beginning of 2000 here. But what you can imagine is that, the quits rate probably went up and up, and it peaked just before the recession, had a boom, a bust with the end of the recession. Then things got picked up again, another boom in the quits rate, and then a bust with the 2008 recession. If you take a look at the 2010s, something is missing. You don't see really booms and busts. In fact, it takes until really, just before the pandemic to reach the highs in the quits rate that we saw in 2005. Now, the lack of booms and busts, to me, is, and this could easily be being me, just extrapolating things, but what this suggests to me, rather, is that the 2010s, we didn't really have a recession per se. It was, as I call today's, inflation fears, inflation PTSD, I would call this, what we saw right here from 2009 till to 2020, 08 PTSD. You saw people hold back because they were afraid of having to deal with 2008 again, all right? And low quits rate is associated with low confidence. And if you look back at history, what you'll see is that 2010s are sluggish for growth. And all of a sudden, that becomes consistent with what I was pointing out before with the Fed. The Fed wasn't anticipating recessions. It was reacting to weakness. It was reacting to the fact that people were unwilling to spend. And they were unwilling to spend because of what happened in 2008. People were still trying to get through it, still trying to deal with it. And that manifested itself via people just acting in a more conservative fashion. And you can see that with spending habits and GDP overall. The 2010s are associated with sluggish growth. So, for example, say that you put money in the stock market and the stock market went up. What you are more likely to do is say, good, all right, I'll keep that money aside and I'll feel good about myself, but I'm not going to spend it. I'm going to keep it aside because of this, because of 2008. I don't want to live through that again. All right. So again, the Fed is reacting to a weakness, and it's reacting to the fact that people are still trying to get over what we saw in 2008. Now, how does this connect to today's really environment to what we saw in 2006? Well, 2006, 2008. Well, really, what happened after 2020 is the pandemic. And the pandemic changed a few things. Well, first of all, it was the first time when, we got collectively locked up, was locked down. At the same time, so we couldn't go out, couldn't have experiences, you couldn't go to a restaurant, you couldn't travel. And at the same time, governments basically bailed out everyone, right? It was a bailout of the entire economy. Stimmy checks, credits, whatever. Just go out and we'll give you money, all right? Just don't go bankrupt. That was basically, the gist of it. As the economy reopened, all of that pent-up demand kind of jolted people out of the 2010 malaise. And that manifested itself with increased spending. If the stock market goes up, I'm going to spend that money because I'm so sick of, everything that I couldn't do in 2020 and 2021 because of restrictions. I'm going to do it because why not? What happened? What if something like that happens again? I don't want to have regrets in life, and then you have, the kind of economic nihilism, as, many economists have labeled it. But regardless, people went out and they spent. All right. This manifested itself really in the quits rate. You can see labor market participants really acting in a more aggressive manner, potentially overdoing it, potentially leading us back to a time that is more consistent with the pre-2008 world. A world where there are booms and busts, and a world where the Fed potentially just stays on its hands a bit longer and waits for the weakness to hit it in the face. All right, and now this is really a lot of extrapolation for the quits rate. All right, I recognize that. But I like it. I like how it all kind of fits together. I could easily be wrong. But one of the things, and this is really me answering the comment, what really puts 2006 and 2008 at a comparable level with today is that potentially today, because of the consequences of the pandemic, we are no longer in the 2010 malaise kind of economy where people are really just, generally speaking, unwilling to take risks and spend. Rather, we are in an environment that is more consistent to what we saw before 2008, where people, overdo it. They do too much on the way up, so you have a boom and the eventual bust. Now, is this the low for the quits rate? I don't know. A lot of the tariff drama could, it could easily make me believe that, there's further down to go. If I really wanted to get exotic, I would say 1.5 for, just chart reasons, but, I don't want to get arrested by, the macro police for doing technical analysis, and rightly so, technical analysis on, on economic data. But that's besides the point. Again, one of the reasons why I think, even though we have different catalysts, and again, tariffs, and I'm going to speak about tariffs in the second part of the video, we might have different catalysts and different problems to deal with, but at a fundamental level, the economy is no longer in the state, in my opinion, of, well, what it was in the 2010s. Potentially, we are back to something that is more similar to what we would see in the pre-2008 world. A world where people spend, and potentially they spend a little too much. Perhaps they act a little too aggressive. And so you have the booms and you have the busts. All right. And really, the context for this comparison is, if you haven't watched my previous videos, because there is an eerily similar chart pattern between the 30-year yield in 2005 and 2006 and what we're seeing today. Now, as I said many times, I'm just waiting for the moment this kind of comparison falls apart, because I'm not advocating for canned beans and and corn and hiding in a bunker. I don't want the world to end like that. So I'm just waiting for it to kind of, dissipate. And in case you haven't watched my previous videos, the basic idea is you have a small uptick in rates. Rates decline, then a noisy uptrend followed by sideways action, and then the first stop and your W formation, or whatever you want to call it. From 2020, you have the first rise, then a decline, noisy rise followed by sideways action, first stop, W pattern. Now, arguably today is probably this week's price action so far, you could actually say that it is deviating for the first time. All right, so that is kind of the good news or bad news, depending on your views on the 30-year yield and whether you're long or short. Okay, but again, the point in looking back at 2008 is that yes, they look eerily similar, but at a fundamental level, I do believe that there is a case to be made that we are closer to a kind of economic cycle that is more similar to the pre-2008 world, where people have money, and if they have money, they'll spend it. And, that generally leads to boom and bust cycles, all right? Does it have to play out exactly like 2006, 2008? Absolutely not. And as, the Zinex, for, simplicity's sake, rightly pointed out, there are different things. So again, to answer the comment, I just I thought it would be a good idea to further elaborate and kind of bring all of my videos together in a single video. I thank Zinex once again for your comment. I do appreciate everyone commenting, and whenever I see videos, I try to answer. And in this case, I like the comment, and I thought it was a good occasion to kind of bring everything together. So thank you again. I hope this kind of adds a small piece to the puzzle, to the comparison, really. So again, just to summarize everything, the idea is that what we saw from the Fed in 2010 and the 2010s is a reaction to weakness that got broken with the pandemic, which catapulted us, because of being locked. People were in lockdown, they couldn't go around, they couldn't spend. That kind of broke the spell of the 2010s and brought us back potentially to something that is more consistent with pre-2008 economies, where people would overdo it on the upside and overdo it on the downside. So booms and busts, which you could point to with a quits rate itself. Okay, quits rate goes up, people act in an aggressive manner. They are confident of what they see in the labor market. So that leads them to drive wages up and up and up and up until something kind of breaks, because we overdo it on the way up, and you have your bust cycle. All right. I personally, and now I'm going to talk about really the second part of the video. Again, I'm still of the opinion that it is very, very early, way too early to call potential bottom on things like stocks. like today we were up something like 3 to 4% if I'm not wrong. Let me see. Oh, this isn't it. But in any case, we were up by a lot. All right, we were at 5,200. Yeah, we were about 3% up, right? 4% up at a certain point if you consider the wick. So, and that really came on the back of, a lot of optimism. And I think that there is a weird mechanic in that is occurring, and it keeps on occurring ever since really Trump got elected. Trump keeps pointing at the fact that he's going to act in a certain manner, and he keeps pointing towards mainly doing tariffs and applying tariffs, and the market keeps getting surprised at the fact that he doesn't do it. All right, now again, things can change incredibly fast. Like now I'm seeing the Nasdaq pop higher and the S&P pop higher. Probably some news came out as I'm speaking. But in general, I think that it is best to prepare for tomorrow. And in fact, what we've seen so far is, if you've read the news just an hour ago, China tariffs seem to be going on already today because they missed the deadline to pull back their retaliatory 34% tariff on the US. So unless I see another tweet, I'm checking, real time here. I don't seem to see any such news. But again, to what I was saying before, I go back. Just because something sounds ridiculous, and I was saying this yesterday, doesn't make it unlikely. I think that April 2nd really has to teach us something. We have to learn something from April 2nd. Just because something sounds ridiculous, just because 104% tariffs on China sound ridiculous, with this kind of regime that we're in, and I mean, not regime in the state sense, regime economic sense, of economic regime, you get what I'm saying. I mean, you have to kind of take him at his word, because I mean, you just run the risk of getting caught offside. We were talking. I was making videos prior to right here to April 2nd. I was pointing out the fact that there was indeed a potential for some maximalist approach, and even I didn't believe that he was going to go through with what he actually went through. But here we are. Okay, here we are. So April 9th is tomorrow. I'd still be extremely cautious of taking on huge bets at this point, because things can move extremely fast, and as I've said, they could get resolved immediately, and they can get worse immediately. All right, just like we saw tonight. I'll keep on refreshing. This part of the video could be irrelevant by the time I finish it. But what can we expect tomorrow? I think there are a couple of outcomes. I think that given what we've seen today, tariffs might end up going through, on April 9th. However, I would not be surprised if we get the outcome that was kind of pushed yesterday and actually pushed markets up, for about 15 minutes, straight after the open, which is tariff delay for allies and partners of, say, 45 to 90 days. I think this is one of the potential outcomes. That we have to consider. Now, what is the framework for tariffs? I've talked about this many times. I do believe that the end game is indeed China, okay? But the middleman is Europe. And I think that the number one objective, while it is China, it really is the EU, though, for the being the middleman. Because in a potential standoff with China, I'm not talking about World War III, I'm just talking on an economic level. Would it be better for the US to face, quote unquote, China with the EU on its side or without the EU? The answer is with the EU. And what could a possible deal with the EU, entail? And really, the delay would be for, striking a deal. All right. What kind of a deal could we be talking about? I wouldn't be surprised if it's an energy deal with Europe. Basically, decoupling. I know that's a fancy word that's getting used again as of late. Decoupling the EU from Russia, potentially energy. So EU buying LNG from the US instead of Russia. And really acting as a bloc against really China. All right. I think this is a potential outcome. Number two is really what, at least for the moment, for the sake of the video, I'll take for granted that they've been actually approved, and we're going through with the China 104, which in practice isn't 104% tariff, is really potentially above 110, given the fact that, if I'm not mistaken, China imports oil from Venezuela, and the US has an extra tariff on whoever imports from Venezuela. So, it's 104%, but it's potentially even higher. So keep that in mind. China 104% tariffs get put in place, just like, potentially headlines have been pointed towards now. If this goes through, I don't want to make any further forecasts on the consequences of this, of China having 104% tariffs. We could easily see, and the optimist in me goes back and thinks about 2018, where you saw a lot of saber rattling, even back then, on tariffs, and then a month later we had a deal. All right. For sure, as I was expecting after April 2nd, I'm not expecting things to get resolved immediately. Simply because, whoever backs off first just looks like a wuss. That's the sad reality of things. Even though we'd like for things to get resolved immediately, the sad truth of it is that, again, if Trump backs off after shooting a huge bazooka at the world, he just looks like an idiot. Again, just because he looks like an idiot doesn't make it, impossible, just to clarify. But he will look like an idiot, potentially. Same thing, China. They will look extremely weak if they just say, you know what, you're right, we'll do whatever you want. Same thing, Europe. Although from Europe, we still haven't gotten anything from Europe, arguably. There was some speculation that perhaps we'd see tariff retaliation, and then we saw 0 for 0 tariff, being put out there. So it's kind of all over the place. And that is really the risk that, is out there for the moment. It's that so far, the most ridiculous outcome, so 104% tariff on China, seems to be, we seem to be going through with it. And again, that is potentially the worst news of the day. I personally feel comfortable with pointing these two things out. For allies and partners, I wouldn't be surprised if we do indeed kind of massage things and say, you know what, yeah, we'll have a delay, and during that delay we come to an agreement of some sort for I don't know what. Okay, I pointed maybe towards energy, maybe towards arm deals with the EU having to restock on armaments or whatever. I have absolutely no idea. And really, before just a few hours ago, before I was thinking of making the video, I didn't have time to. But I would have pointed towards this being the worst case scenario, because it puts China in a corner. If we actually, we're getting 104% tariff on China, which, by the way, again, is likely higher than 104%. It leaves the door wide open to a lot of things. Further retaliation from China, or I have absolutely no idea. So what I would like to get across at this point of the video is that, there's a lot of uncertainty, and it isn't really the time to be a hero. One thing that I do not like is the fact that we continue to try and call a bottom. All right, that is one thing that leaves me uneasy. Because again, it's kind of the opposite of what happens in a bull market. Like in a bull market, you'll have people continuously call for a short, call for a top and short it immediately, and then you have these incredible, short-term dips. This was a 10% dip, if I'm going to say 5 or 10%, 6% dip. This right here was another, if I'm going to say, yeah, this was the 10% dip. But overall, the trend is up. If we are no longer in a bull market, and potentially we're in a bear market, the opposite of calling a top is calling a bottom. And you just call a bottom here. All right, this is the bottom, and yay, I bought the bottom. Everything is going up, and then it doesn't, and then yay, I bought the bottom again, and it's going up, but then it pukes again. And then I buy the bottom here, and everything is rallying, and I'm a genius, and then everything just rolls over. At the end of the day, sadly, there are still things bugging the market. All right, and as I've been saying for quite a long time, sadly, we are being held hostage by economic data, by economic policy, and all you can do is wait and really not get killed in the meantime by incredibly volatile price action. Right now, even though yes, in the long term, all right, even 2008, what happened in 2008 is a blip. What happened in 2022 was a blip, right? If you bought, even if you bought here at 4,800 and you had to go through a 20% haircut and you held, you were still up. What was that, a 25%? Yeah, nearly 30%. Yes, granted, in the long term, eventually stocks go up. So there's absolutely nothing bad, in my opinion, to just kind of nibble here and there. But if you're just trying to call a bottom, I don't think that's the time really to do it. I mean, I would maintain a cautious outlook. Just go outside, touch grass, look at the sun, catch some sun, and that's it. Wait for the things to clear up. There'll be time. You don't have to buy the exact bottom, all right? Nobody buys the exact bottom, all right? If you had bought in 2022 and you bought at 3,800 instead of buying at 3,500, what difference would that have made, in the grand scheme of things, all right? So I would just have patience on the equity side of things, wait for clarity, potentially lose out on a couple percentage points of return, but at least you'll sleep well at night. You don't have to kick yourself because you tried to buy the dip here and then here and then here, then who knows, maybe here, because things had a worse outcome than many expected. All right, so I would be cautious on the stock side of things. On the bond side of things, we're still not in the clear yet. When we were up here, again, as price moves up, my expectation is that you kind of take a retest of this trend line off the table. But again, if we move back down, well, then you have to consider that. One thing I will point towards is that I have no idea what is causing, bonds to kind of not perform as one would expect. What I will say is that if you look at things like gold, ever since, Thursday, 3rd of April, from peak to bottom, gold was down, 6.7%. If you look at TLT, from peak to absolute bottom, more or less the same. All right. If I had to point towards something, I would point to the fact that we have had a traumatic event. All right. We have had to go from everything's great and stocks are going to end the year at 7,000 or 8,000 or whatever, analysts' forecasts were. And we've had to go from this to this. All right. And in the meantime, that's a 20% haircut in really a couple of weeks. And it came out of the blue, meaning that people really could not prepare for that. All right. When something like that happens, and you have to raise capital, you have to raise cash, what do? Well, you sell your winners. Gold's been performing like an absolute stallion. It's at 3,200. I have to raise some money. I have to rebalance things. I'll sell some gold. Bonds, same thing. Bonds have been outperforming stocks in this first quarter of the year. If I had to point at something without, considering all the doom posting and, whoever's dumping US treasuries and we're going to all die of, whatever, I would potentially point to that. Unless, we get some news headline that actually gives you a reason to believe that, the world is going to collapse, then, then you can tear your hair out. All right. That's what I'm trying to say. So far, I would just ease off the doom posting on both on bond side and both on the equity side. Of course, there are going to be consequences if we get the worst case scenario, and for that reason, I advise caution on whatever it is you're considering, be it stocks, bonds, Bitcoin, whatever. Try not to be a hero. In my opinion, I think that is the most sensible advice I can give you at this point. One last thing I can point towards is the yen. The yen today has seen, strength. Small caps are getting hammered, and stocks have really flipped, from being in the green, losing 1,000 points on the Nasdaq, for example. I actually would like to see, I haven't taken the time, I'd actually like to see if the sell-off in stocks really coincided with the yen. Let's take this high point. So this is 2:15. Let's go on the 15-minute chart. Yeah. Really? Yeah. No, it started at the same time, more or less. So there goes, your risk-off correlation. Now, arguably, you haven't seen that yet in bonds really, perform in risk-off manner as you would expect. But if indeed we are to face, more of the same, meaning worse news than, we were expecting a little while ago, I would expect, gold to continue to perform unless we have some kind of liquidity event, and during which, said event, if you look at history, like mainly 2008 is a fairly good example. This only goes back to 2017. There we go. If you look at what happened in 2008, gold had from the peak in March, where this is really where Bear Stearns collapsed. It took a 35%, a 34% haircut. All right, so if you have some kind of, again, dramatic event, financial event, gold tends to suffer. In this kind of environment, the risk off trade is, the only thing that works, and the risk off trade being treasuries, which again, there's a lot of speculation on treasuries until you have definitive proof that it's the end of the world, and I would avoid trying to read all the doom posting, both on bonds and the equities and everything, especially during volatile times. It doesn't really pay to feed the bear inside of us, and at the same time, I would not feed the bull inside of us, meaning try to be a hero. You don't want to be totally depressed, and you don't want to be a hero. Just be cautious. The markets will be here in a month. They'll be here in 2 months, in a year. There's no need to rush. Okay. So for the second part of the video, I was really talking about what to expect on really tomorrow. I could see these two things happening. Of course, number 2 already happened. All right. So I would await further, news on the China tariffs. Again, this video could very well easily be irrelevant by the time I publish it. But in any case, it's not the time to be a hero, in my opinion. Keep a cool head. And wait for news and see if things are better or worse. All right. The only thing I really feel comfortable pointing out is the potential that, yes, tariffs might get put on, allies and partners. But I wouldn't be surprised if what broke news yesterday, meaning, the possibility of there being a delay for allies and partners, actually kicking in. One other thing, and I'll end the video on this, as one of the next things I was going to talk about, but I'll make another video at this point because we're well above 40 minutes, is the fact of the matter that regardless, there will be consequences even if we do have, the tariff drama kind of dissipating. I saw Scott Bessent describe it as a block of ice, that just melts away. Because you do have to consider kind of the wealth effect. Now, the wealth effect works on the upside and it works on the downside. And arguably just this kind of a decline in such a short time frame, at some level, will probably make people uncomfortable with the stock market and potentially, again, make people pull back just a little bit. All right, but that's a topic for another video. I think I'll end the video here. The last thing, then I promise, the last thing I want to talk about, I'll mention, is the credit spreads. This is something that I've been pointing at for the better part of the last 2 weeks. And we are above, and this is yesterday's numbers, so I'll wait tomorrow to see where today's numbers are. But credit spreads so far are back at 2023 and May of 2022 levels. It isn't per se, in the context of history, an explosive move. However, we are well above the lows. We are about 200 basis points above the lows, which at this point is substantial. All right. I would continue to keep an eye on credit spreads because as the spread keeps moving up, that will have consequences on things like small caps potentially. So keep looking at credit spreads if you really want to. Keep an eye on the market. I would keep an eye on credit spreads, really. So Again, thank you to Zinex. Gave me the chance to rant a little bit about everything. So thank you again. I appreciate your comment. I hope you appreciate the extra piece of the puzzle, as I called it. And again, thank you to everyone that's been following my videos, been liking, commenting, and subscribing. I appreciate all of you. All I can say is a massive thank you. And I'll leave it at that. Again, if you like this kind of content, consider leaving a like. And I'll see you next time. Bye.